Welcome to another episode of Family Office Real Estate Insights. Today, I have Jimmy Atkinson with us with OpportunityZone.com. Jimmy, it was great to see you at our annual conference last week, or a couple of weeks ago, actually, and having you back on the show.
Yeah, pleasure to be here, DJ. Thanks.
So we started, and I think the time is actually a really good time for us to chat because we are going into the, this election. And
Right.
what I saw was a pure Trump coming in the office. I would have bet on the thing as soon as, Biden stepped out. All of a sudden, we started seeing this sway, happening. And they both have different thoughts about opportunity zones. They have different thoughts about taxes. They have different thoughts about Medicare. I mean, everything right across the board. And you've been doing this since the beginning. And so I want to know what you think is probably going to be happening, or based upon which legislation, comes into office.
Yeah, well, first of all, I think the biggest mistake that Trump made during this election season is allowing that debate to take place so early in the season. I think the Democrats wanted that debate toward the end of June, kind of just to test out Biden to see if he could survive it. And clearly he did not. And then ever since then, Trump was winning big, as you said. And when they went to replace him with Harris, it's now, if you look at polling and if you look at the futures markets that cover the election, it's 50-50 as we sit here right now, early October, when we're recording this, DJ. So I don't really know what's going to happen. But that said, of course, whoever wins the election, not just the presidential election, but also who controls the balance of power in the Congress, who wins the Senate, who wins the House of Representatives, is going to have a huge impact on tax legislation in 2025. Some on Capitol Hill are calling it the Super Bowl of tax because there's so much of the Tax Cuts and Jobs Act that expires at the end of 2025. Mm-hmm. And if nothing happens in Congress, if nothing gets signed into law by the president prior to the end of 2025, taxes are going to go up for 62% of the American population. And they will first feel that impact in January of 2026 when their first paycheck comes through, and it's going to be smaller than they're used to seeing, right? With the withholding rate. So nobody, whether you're a Republican or a Democrat, wants to be in office when that tax increase hits, because you're the one who's going to get blamed. Now, how they deal with that situation, exactly what goes into tax legislation in 2025, is anyone's best guess. But clearly the Republicans have different priorities than the Democrats. Republicans seem to be more favorable toward opportunity zones than Democrats. I can discuss why that is. I don't think it should be that way, but that opportunity zones have become political. But we'll see how it all unfolds over the next few weeks here. We're getting close to the election, DJ.
Yeah, I'll tell you, it's there. This is a huge time. You're 100% right, because of those tax components that are going to be falling off the books, right?
Yep.
The one thing I will say is that what amazes me, and I was talking about this the other day, is that you continue to hear, at least I do here in our region, about people that are, ads that are saying, well, the rich need to pay their fair share, etc. And
I'm seeing those too. Kamala Harris is going to tax the billionaires, make them pay their fair share.
Yeah, well, here's the thing, and Trump said this when he ran the first time, but nobody brings it to light, which is I'm just playing by the rules that you gave me. So these are the things that I can do and that I can't do, and based upon what you've put into for the regulations, by following them, it allows me to pay less tax, right? So it's not necessarily that they're trying to sidestep it. I think they're just using what's been available to use. They're just being smart about it, right? Or they're able to hire people to really look at it to say, okay, how can we really maximize this opportunity, or what the case is? Sure. But why do you think that you brought up something which is interesting to me, is that you said that the Republicans have the thought process for the opportunity zones between the Republican and the Democrats. Talk to me a little bit more about that.
One word, Trump. That's the reason why. So let me rewind. Opportunity zones were first conceptualized in a white paper produced by the Economic Innovation Group back in 2015. It was co-authored by Kevin Hassert and Jared Bernstein. One of them is a Republican, served in a Republican White House. One of them is a Democrat, served under Obama and in the Biden administration as well. It really was a bipartisan effort to come up with this opportunity zones concept. The Republicans like it for the tax breaks, and the Democrats like it for the revitalizing these poorer, lower income communities. That's a simple generalization, but that's directionally accurate. When the opportunity zones concept turned into a piece of legislation called the Investing in Opportunity Act later in 2015, it was co-sponsored by members on both sides of the aisle, Democrats and Republicans. They brought them in 2 by 2, just like Noah's Ark. So there were exactly the same number of Republicans who co-sponsored it as Democrats, and in both houses of Congress, both the House of Representatives and the Senate. So it was bicameral, bipartisan. Now, unfortunately, what happened was it was passed eventually as part of this much larger tax bill, which I've mentioned a few minutes ago, Trump's signature tax policy, the Tax Cuts and Jobs Act. Opportunity zones is like a 6-page portion of this hundreds of pages of tax legislation that was passed at the end of 2017. And then in 2018, it was the Trump administration that administered the program and regulated the program. And so if you're a Democrat, all of a sudden Trump is getting credit for this Opportunity Zones program. Trump's putting his signature on it. The New York Times is writing an article about how it's a scheme to help his fellow real estate professional friends get rich and save more on taxes. It received a lot of negative press because Trump was in the White House at the time, because the Trump administration branded it as their own. Trump has been referring to it recently on the campaign trail. He referred to it during the debate with Joe Biden, the success of Opportunity Zones. He brought it up again during his speech at the Republican National Convention. He had Senator Tim Scott, which was probably he is the most prominent sponsor and champion of the Opportunity Zones program from the Senate. He had Senator Scott speak at the Republican National Convention. So all this is to say, for better or for worse, it started as a bipartisan policy with real bipartisan roots, but it has since evolved or devolved, depending on your perspective, into a Trump program, which I think is unfortunate because it really is a bipartisan program. And if you look around the country, mayors in blue cities and in red cities love the program for the dollars that are coming in. Governors of blue states and red states alike like the program because of the dollars coming into their states. But at the national level, when we're talking about national politics, really, we haven't seen Democrats in Congress or any Democratic presidential candidate, neither Biden nor Harris, support Opportunity Zones at all. Where on the Republican side, Republicans really are supporting it, not quite as vocally, perhaps as I wish they were, but certainly much more vocally than the other side of the aisle.
That surprises me on the Democratic side, because I would think, being supposed to be in these lower income areas,
Mm-hmm.
to help those neighborhoods, that would be more of a Democratic push and support.
Yeah, but the problem is it's a Trump program. So you can't, as a Democrat, you don't want to draw too much positive attention to it because it is a Trump program. The mainstream media really, I feel, did a disservice to the program by branding it early on as a scheme for the rich to get richer and to save more money on taxes. And certainly that's part of it, right? Like, look, here's the deal. Here's the deal that we kind of agreed to in Washington is we gotta unlock some private capital. And where is that private capital? It's on the balance sheets of very wealthy individuals, wealthy families, wealthy corporations. And we have to get some of that money and incentivize that money to flow into these lower income communities. Well, how do you incentivize it? You have to give them some sort of tax break in order to do that. And then, but the end result is the positive work that's being done in these low income communities. And, you know, to the credit of the architects of this program, $150 billion of private capital has flowed into these lower income communities since 2018. It's the largest, most successful economic development program in US history. It's incredible what's been accomplished with this program in such a short time.
Okay, well, okay, let me stop there because I have questions along that line. Because my first off, when they came out with the census tract and we talked about this, there were some areas that just shouldn't have been the case. I mean, here in Denver is a prime example. The where the stadium is for the Broncos is an OZ, and
Yeah.
there's some amazing developments that's going to be, you know, button up against to that because of the OZ, right? So and then you've got places in New York and Vegas and different places that you're like, I mean, even you know, up in Hollywood, the same thing. There's different locations. But one of the things that when I first looked at this, and my feeling for this whole thing was that, okay, this is great. You are getting, but I don't think it's going to have the impact that people think. And the reason why is because you're building, you're going in, you're building because you have to do either major development or redevelopment or development, right? So you're going in, you're going to create a really nice place for people to live. And then there's going to be the coffee shop that gets put up. And basically, you end up displacing the people that you weren't supposed to displace. Has that happened? Because to me, it seems it would just be a natural progression as that area is being developed.
Yeah. By the way, that is true, and that has happened in some pockets around the country. First, I think you've got two separate points there. First is some tracts might not have been worthy of being deemed opportunity zones. There's over 8,700 census tracts all around the country that were deemed qualified opportunity zones in 2018. And if you look at a handful of them, maybe there's a few dozen or 100 or so that are head scratchers. Like, really, is this an opportunity zone? A couple things you have to remember. One, the census tracts, the actual physical geographies of the census tracts, the boundaries that are written on the map, was established in the 2010 census, because that's the most recent map that they had. Now, the data that determined low income or not low income is according to data from 2015 or 2016. Sometimes that data lags a little bit. Sometimes, you know, it doesn't really capture a trend, an upward trend. It's merely a snapshot in time. So some of these areas, yes, were already on the rise when opportunity zones came into play. And then, you know, investments, the first qualified opportunity zone funds couldn't be established until 2018. Well, by that point, the data is already 2 or 3 years old, right? Yeah. So yes, to your point, there are some zones that are head scratchers. There's legislation pending in Congress right now that would disqualify many of those zones and give the governors of those states that are affected another bite at the apple, effectively, another chance to redesignate new opportunity zones. That's pending in Congress, and I don't expect it to pass anytime too soon, but possibly next year during the 2025 Super Bowl of tax. Your second question was, you asked about, you know, are residents being displaced? I think almost certainly that's the case in some parts of the country. I don't see how it can't be. Unfortunately, there isn't a lot of data other than anecdotal evidence supporting whether or not opportunity zones are benefiting the local current residents there or not. But the policy is designed to spur economic activity in these areas, because our policymakers in Washington consider economic development, economic revitalization to be a public good, something that we should strive for. And that is what this program is achieving, is economic revitalization. As a side effect of economic revitalization, yes, some local residents do get displaced. There are some opportunity zone funds that have a mandate to do really good by the local residents. They have, and this isn't necessarily part of the program. These are some operators that are going above and beyond, hiring local, putting in workforce training, making sure that all their construction crew for the temporary jobs during the development phase are hired locally. Again, this isn't required by the program, but it is something that some funds with more of an impact orientation are doing, DJ.
So This just it goes to a bunch of different questions that I have along these lines. So we've got we have we're coming to the end, right? When's the actual tax benefit supposed to be closing up per
Yeah.
se?
So it written into the statute, into the Internal Revenue Code, is the date December 31, 2026. That's the deferral date. That's the last date to which you can defer capital gains dollars by rolling those gains into a qualified opportunity fund in timely fashion. So that's not necessarily the last date that you can make an investment, because the IRS, or the statute, I should say, gives you 180 days beyond the date of your capital gain recognition to roll over that gain into an opportunity zone investment. So about 180 days, if you trigger a gain on the last day of 2026, you technically have until middle of June 2027 to potentially make that opportunity zone investment. There's a few other nuances I won't get into. Some people might have until September of 2027 to make their final opportunity zone investment, though.
So, and if you write a check and you're going to go into an OZ, regardless of when that happens, you have to wait 10 years, right? So
That's right.
Even if you come in on something that's 3 years already happening, you can't say, okay, I'm already 3 years taken care of. You still have to go a full 10, right?
Correct. Yeah. If you trigger a capital gain today, and then within 180 days, you write a check, let's say it's for $100,000, because you want to be an LP in somebody's opportunity zone fund. Maybe that fund has already been open for 2 years, right? But they're still raising capital. Your 10-year clock doesn't start until the day that they get that check, the day you make that investment. So you're not just 8 years out because they're 2 years in. You're 10 years out because that's when you put your money in. So you would have to wait until 2034. Let's say you make the investment tomorrow. You'd have to wait until October of 2034 to get your full 10-year benefit.
Okay, so let's say I do come into one of these where it's already 3 years in,
Yeah.
right? The property goes 10. I'm still stuck with 3 years.
Yeah.
I've got to find some place to put that. I mean, to what is probably the most likely scenario that the investor could look to have to decide? I mean, they've got to go into another opportunity zone at some point, right? To finish those last 3 years.
It depends what happens at the fund level. Does the fund divest of the asset and distribute cash back to the investor?
Well, let's say that, okay, so it's already 3 years in. So those people that started on day one,
right,
10 years from that day, they're done. They're like, I have no tax. I'm in good shape. Well, if I came in on that same fund at the third year, they're still selling 7
Yeah. So
years.
in that case, I think
left.
the fund's doing a disservice to the folks who come in late to provide their last leg of capital. So I would say, as an investor, if you're coming into a fund that's already been open for 2 or 3 years, that's a great question to ask that fund manager. Hey, you're not going to sell this asset in 7 years, are you? Because if you are, then that does me no good. If that happens to you, you're out of luck, because you've got all your capital returned. There's nowhere else to put it. The Opportunity Zones program has been shut down by that point.
Oh,
so what's
interesting?
What should happen is this. And by the way, a lot of Opportunity Zone funds are set up, not all of them, but a lot of them are set up in vintage years. So different organizations, different operators, developers might have a 2021 fund, and then they'll close that and then open a 2022 fund. And so those people in those vintage year funds kind of know, okay, I got to hold this until the end of 10 years beyond the date of this vintage year. Now, not all funds are set up like that. Some funds are open for 2 or 3 years, to your point. I would say this, by the way, the fund may not offer investors who come in early a chance to exit after 10 years, because they want to wait until the last investor in reaches his 10-year clock. Now, how do you
which is
how do
another
you
thing that you have to ask. You have
right?
to.
But so as an early investor, how do you get compensated for that? Well, there's a few different
Yes.
ways that funds can compensate that early investor. One is offering bonus shares or effectively a better valuation on the shares because you're essentially an early adopter, an early supporter of the fund. Another way that a fund can do that is they can potentially buy back those investors' shares after 10 years. If they really want to get out after 10 years, the fund can oftentimes just, okay, we'll mark the asset to value, and then we'll purchase your portion of the asset back from you. Here's your return of capital plus appreciation. Um, you've got no tax liability on the gain there. So that's another way that you can skin that cat, DJ.
But it's very interesting. I never even thought about that, because if you can't go into another, you can't reinvest.
Right.
You're stuck. You're going to pay taxes, and so what was the point? I mean, it didn't make any sense, really.
Well, I
Especially,
think most funds are going to do right by that last investor in. Now, the fact of the matter is, by the way, we have no evidence, no data on what has happened with any of these funds because none of them have reached that 10-year mark yet. The
yeah,
first OZ investors started funding qualified opportunity funds in the earliest it could have been was July of 2018, which is when the OZ map was finalized. So I think talk to me again, DJ, in toward the middle or end of 2028, and I should have some data on some of those first 10-year hold exits for you.
what about the we've spoken before where a lot of people thought that family offices were going to really be driving this whole
Yeah.
thing, and that hasn't been the case. A couple of reasons. One is what you just brought up, which is the regs weren't solidified
Right.
until later, and then there's the lack of understanding. So you've had a lot of high net worth that's gone in to these, and they've got to be buttoned up against having to pay their cap gains portion, right? Since the initial investment. Well, a real family office or extremely ultra wealthy person, they're going to have access to other funds. Some of these high net worth may not. They might have sold their business. They might have sold their, some property or something, and they're like, "Oh no, I've got to come up." Has there been any discussions about, uh, you know, the potential outcome or a solution for that, or are operators worried about that? Has that been a topic at all?
It's a good question. And what you're referring to, just for anybody who's not aware, is that the gain that you defer into an opportunity zone fund, that gain gets deferred until December 31, 2026. So April of 2027 rolls around, and the liability on that gain comes home to roost, and you're going to owe typically 23.8%. I don't know what the tax rate is going to be in 26, by the way, right? But the 2026 rate is going to apply. So whenever I make a presentation on opportunity zone investing to a group of high net worths, I always caution, hey, by the way, don't forget, this tax liability comes home to roost at the end of 26, payable 27. You're going to need some liquidity. You're going to need some funds to cover that tax liability in 27. So be aware of that. And that goes to a question of suitability. Is this type of investment suitable for you? That's why a lot of these funds, the vast majority of funds, almost with no exception, require that the investor be an accredited investor, a high net worth individual who's likely capable, hopefully, of covering that gain liability in 27. Some funds, especially ones that rolled out early on, had a provision in their operating agreement, or at least had some vague promise in their deck that said, look, we're going to do a cash out refi
Yeah.
in 2026 to our investors so they can cover that tax liability in 2027. Now, a lot of those promises were made, a lot of those projections were made during our zero interest rate policy. And now rates are up much higher than they might have anticipated when these decks and these promises were made in 2019, 2020, right? I think the interest rate cuts that we saw a few weeks ago, and that hopefully we'll see more of them toward the end of the year here, I think those will help quite a bit. We'll see what the rate looks like in 2026, but hopefully a lot of those funds can do some sort of some sort of refinance distribution to its investors to pay out to pay back some of that capital, so the investors have something with which to pay those tax liabilities. Well, also, by the way, if you got in early enough to a fund that started maybe in 2018, 2019, 2020, hopefully those assets, those projects those ground up developments are stabilizing and getting leased up now. So the investors should start receiving cash flow from them too. I know a lot of them are starting to cash flow already. Some of the earlier ones are cash flowing back to investors. So if you're an investor and you're an early investor in one of these funds, just remember, hey, I've got a big gain liability due in 27. Start saving away some money now.
But the other thing too, I think we were talking about this the other day, is that based upon where the market is at the time, that value of that opportunity zone may be less, which would help offset some of that tax liability.
It would, right? Because the amount of gain that you recognize on December 31 of 2026 is equal to the lesser of the gain amount that you rolled into the fund, or the fair market value of your position in your qualified opportunity funds on that date. Now, most of them, I think, may not depreciate in value by that much. But it'll be interesting to see, what kind of valuations some of these funds place on their assets and the fund shares on those dates when that rolls around.
And that's, you said, at the end of 26.
That's December 31, 2026. And by the way, it's going to vary, right? I mean, if you got into a fund early enough, by the way, but if you're an investor in a fund prior to the end of 2019, you actually receive a 15% basis step up, which essentially means you get a 15% reduction in the amount of gain that you recognize on that date. If you got in before the end of 2021, you get a 10% reduction in the value right there. So that helps reduce your tax liability as well. Some of these funds will, like I said, already be stabilized, leased up, and cash flowing. Others will just be a big hole in the ground, right? Depending on, look, did you invest in a project in 2019, or did you invest in a project in 2024, or 2025, or 2026? That's really going to depend on, those facts are going to factor into what the fund looks like and what the asset values look like on that date.
Well, there might be a savings grace because, as I've been saying for years now, and I said it at the Ford Institute conference a couple of weeks ago, that we're probably going to see a recession on the real estate side coming in 27, 28, which could be a blessing for many people. Because
it might be too late though, DJ, because that deferral date's December 31, 2026, unless this pending legislation that I referenced earlier gets through. That would potentially push back that deferral date for everybody until December 31, 2028. And then maybe your recession would be a blessing in disguise, or that would be the silver lining.
Right, exactly. Now, every time that we talk about opportunity zones, people think about real estate. I mean, that's really what's been driving this thing. But there's opportunity for businesses. There's opportunities. I think the real play, and I've always thought this, was on the venture capital side, and having an incubator type of a location. But there's a group we're actually going to be talking to here in a couple of weeks. And I know you had the chance to meet them, which is something totally different that for an opportunity zone opportunity than I've ever heard, actually. And I'm bringing this up just because there are other opportunities that people don't realize that are aside from the real estate, and that has to do with the Wyoming Reserve, right? I know that you were up there. I saw some of the pictures there. That looked pretty cool, but can you just briefly explain what that project is? Because it's totally outside of the typical OZ investment, right?
Right. Yeah. Before I get going, I'd like to disclose that they're a client of mine. I'm paid by them to help promote their fund.
This is perfect then for you. I didn't mean to do this, but
I just like to disclose that before I start touting somebody. That said, they're a really unique example of a non-real estate opportunity zone investment. You're right to point out the vast majority of opportunity zone investments are real estate. I think it's 90% plus, maybe 95% plus. of the types of funds that are open for investment, the types of projects you can invest into as an LP, they're real estate. And the vast majority of those are multifamily. This project in Casper, Wyoming, which is in the middle of nowhere in Wyoming, they do have one airport with 2 gates. I've flown into it once. It was hilarious. The TSA there is open part-time. I mean, it's in the middle of nowhere, which is a good thing because it's really interesting geographic diversification for gold and silver bugs who maybe you don't want to store your gold in a vault in the middle of Manhattan, which is where a lot of the world's gold is stored. You want to store it someplace remote, not very busy, not very heavily trafficked, in a secure vault in Casper, Wyoming. So this opportunity zone business that this company, the Wyoming Reserve, runs, it is a secure precious metals vault. It's attached. They share a building with their sister company that they also own, but is not part of the OZ fund, which is the Scottsdale Mint, where they're actually minting coins and bars for different organizations and governments all around the world. But the opportunity zone business is the actual storage facility, the vaulting business that holds gold and silver on their balance sheet. So it allows opportunity zone investors to invest into a business which holds as inventory gold and silver. So it's a kind of an indirect way to get gold and silver exposure in an OZ investment. They're also structured as a Section 1202 qualified small business stock as well. So if you're an investor that likes QSBS, it's a play there for you. And there may be some way to even stack those two benefits on top of one another. I'm not a CPA, so I'm not exactly sure how that works. But they have an incredible facility. They were nice enough to invite me and my camera crew a couple months back to do a site tour. I got a full access behind the scenes site tour with them, which we just published on our website at opportunityzones.com just a couple days ago. So if anybody's interested in that, they can find out more on our website.
That is, I remember when it's for that. So a business, once again, people don't think about the business, but it's also not only to invest from a business, but also if you're going to be starting a business, right? I mean, if you're in one of these zones, when the OZ started, I got a call from somebody and they were asking me questions and they were just about to have a pretty big liquidation and they were going to start another tech play. And I said, and they were asking about investing into an OZ. I said, you know what you should do? You should start your business in an OZ and take that money and invest into yourself and your own business in that, because whatever that number is after 10 years is tax-free and tech could be considerable, right? I mean, it's just one of those things that happen. And I think that's been overlooked a lot for, I don't know how many businesses have done that, but
I think so. Well, I want to point out another example of a family office in Utah, one of the wealthiest families in Utah, the Hall family. Their patriarch invented the synthetic diamond a few generations back, and now his kids and grandkids actually are in this lab that they built in Provo, Utah, a few miles south of BYU's campus. And when the OZ map came out in 2018, they looked at it and they realized, wait a second, our campus that we've just built just happens to be in an opportunity zone. So what they did, they've already got this beautiful incubator campus funded by their family, and they're incubating all of these patent protected tech businesses inside these different buildings on this campus. They realized, let's set up each of these operations as a QOZB, wrap the whole thing in a QOF and bring in some LP capital as opportunity zone investors. So really interesting, eclectic mix of businesses they have there. They have an electric car manufacturer. They've got a chip manufacturer, a med tech company that develops medical toilets. You should look that up. It's wild. And a few other interesting businesses that are all developing inside there. And their fund closed a couple of years ago. It's fully funded, and the businesses are operational now. A few of them are in revenue and profitable already. So it's a really interesting idea there that family capitalized on. And I wish we could see more of those examples around the country, because I think it's a brilliant um,
Well,
thing to
I
do, but I haven't seen very many of those.
as I was just thinking, I talked about how the Broncos stadium is in an
Yes.
OZ. Well, new ownership took over. The Waltons from Walmart
From
took over
Walmart.
a
Yeah.
couple of years back, and I wonder if that was part of the discussions
I think
because
I'm a Rams fan. I think Stan Kroenke's got some Walmart money too. He married one of the Walton heiresses, if I'm not mistaken. I wrote an article for opportunityzones.com several years back about all of the NFL stadiums that
okay.
are slated into different opportunity zone tracks. And
Oh,
I think,
really? So it's
yeah,
more
so
than just Denver's.
yeah, there's more than just Denver. I think there's about a dozen or more of them that are just happen to be either in an opportunity zone
Yeah.
or immediately adjacent to an opportunity zone. The Rams and Chargers new stadium at SoFi Stadium, where they had the Super Bowl a couple years ago, and the Rams won, by the way. Great game. It isn't in an opportunity zone, but it's across the street from an opportunity zone. So that's one example. But yeah, you're right. The Denver Broncos Stadium, Mile High. Do they still call it Mile High? I don't know the actual corporate
They
name of it now.
do, but then they have a Empower Stadium at
Yeah,
Mile High.
that's what it is. Yeah, that's in an opportunity zone, and there's a handful of others all around the country that are in an opportunity zone.
So just to finish up here, and we could continue to talk. And in fact, I think as we go through this election process, we should do this definitely again. And then once we get into the beginning of the year, but any closing thoughts having to do with where we are today with the OZ, what could be happening around the future, and the future of the opportunity zone?
Yeah. So legislation was introduced a few years back. It's called the Opportunity Zones Transparency, Extension, and Improvement Act. It would do a few things, but the one big thing it would do is it would extend the opportunity zone incentive by an additional 2 years. It would kick that deferral date from the end of 26 to the end of 2028, just giving a little more runway for opportunity zones. I was hopeful that that would get passed as part of some tax legislation in 24, or actually a few years back in 22 or 23 or 24. And it just unfortunately never materialized. And now we're so deep in an election season, I don't see any chance of it passing. I don't see any tax legislation getting passed until the next year, probably toward the end of next year. Now, what that tax legislation looks like and whether or not this small OZ bill gets packaged into it is anyone's best guess. And it's really going to depend on the outcome of the election, I think. I'm a member of the Novogradac Opportunity Zones Working Group, and there was actually a lot of discussion in that group call the other day about, well, what's best for opportunity zones? If we're just if opportunity zones is our only issue we care about, what should we be? What would be the best outcome for opportunity zones? And almost everybody agreed a Republican sweep would probably be the best outcome for opportunity zones. So Trump wins the White House and the Republicans win both the Senate and the House. There's a really strong chance in that case that Trump and the Republicans are going to want to extend pretty much everything in the Tax Cuts and Jobs Act, including opportunity zones. And another outcome is the Democrats sweep. In that case, the Democrats aren't at the moment looking too favorably on opportunity zones. But a year passes, the election's behind us. They don't have to worry about Trump anymore. Maybe Senator Cory Booker, senator from New Jersey, who was the champion of the OZ program in the Senate,
a big component of it.
Maybe he starts liking opportunity zones again, right? Because he can talk about it publicly without pumping up Trump and the Republicans too much. It'll be interesting to see what the Democrats think of and how they talk about opportunity zones if they sweep once we get past the election. In that case, I think some tax legislation would come through with certainly a Democratic flavor to it, but opportunity zones could be a part of that, I think. Now, I think where opportunities are going to get in trouble potentially, and a lot of the Tax Cuts and Jobs Act could be in trouble, is if there's a split of power. If one party wins the White House and then the other party controls at least one or both houses of the Congress, then I think we have gridlock. And I think it's really difficult to pass any sort of meaningful long-term tax legislation bill in 2025 or in 2026 until the next session of Congress gets seated in 2027. And by that point, opportunity zones will have expired quite possibly. So there's a very real possibility that opportunity zones do just go away, at least temporarily, or at least for a year or two. Maybe at some point in time they get pulled back in. Now, if you look at the betting markets, DJ, I'm a betting markets guy. I like to look at those numbers. I look at polymarket.com. And if you look at polymarket.com right now in early October, there's roughly a 50% chance we're going to have a split power in the White House and Congress. I think there's last time I checked, there was a 29% chance of a Republican sweep and a 21% chance of a Democrat sweep. So I don't know what's going to happen, DJ, but that's kind of my best prognostication of what could potentially happen given those three different scenarios. I'm hopeful that opportunity zones do get extended and potentially reauthorized and renewed for a new 10-year run at some point down the road. But when that happens and how it happens is anyone's best guess now. But ask me again in a few weeks after the election. I might know a little bit more.
Well, I'll tell you, I think the one thing that everybody can agree on, whatever side of the aisle you, that the next 3 months are going to be very interesting.
For sure.
And it's going to, nobody really knows which way things are going to go, the directions things are going to go. Jimmy Atkinson, opportunityzone.com. I'll tell you, you've got some great resources up on the site. When I have questions about opportunity zone stuff, I go to you, and that's why we also had you speak at the conference, because I feel that you can talk most intelligently about what's going on. And you brought up Novogradac too. They're a great. If you go to their site, they also show where all the OZ stuff are. They have these maps, interactive maps, and everything else. And that's a great resource as well. So, Jimmy, thanks for being on the show. We're definitely going to be doing this again. And we'll pull this back up after the election to see if any of what we talked about actually came true.
Thanks, DJ. Always a pleasure talking with you.